Two panels have both been highly critical of US lawyers, it seems an appropriate time to point out that Jerry Marlatt, despite being a partner in the New York office of Mayer Brown, is actually Canadian, not American. Joking aside though, Jerry, would you like a right of redress to some of the comments that were made at the expense of American lawyers?
I feel a little bit, after listening to Wojtek, like I should put on the devil's robes and come up here with horns. The process, the due diligence process, is difficult for issuers from countries where it's not a standard process. But I have to say, we issue covered bonds for some Canadian banks, and one in particular that moves very quickly. And on 24 hours notice, we complete the due diligence process and the deal's launched into the market. That's on a repeat issuer. On a first-time issuer, it would take, who we had not done diligence on before, it would take some extensive work. But that's extensive work in the neighborhood of $50,000 to $100,000, not $1 million. So while the process, the initial process in getting started can be extensive and somewhat intrusive, on a repeat issuance basis, it can be done very quickly. So,
thank you. Set the record straight. That isn't what we were intending to talk about, though. What we did want to talk about, though, is a little bit of history. Jerry worked on the structuring of the very first non-European covered bond for Washington Mutual way back in 2006. And it was a very long time ago. The bonds have all matured now, as we heard earlier. But it might be some interesting precedent. So I think my first question, Jerry, is casting your mind back to 2006. Why did Washington Mutual think that covered bonds were an appropriate thing?
Well, I think there are two reasons for that. Washington Mutual's mortgage origination business was growing very quickly. They were funding themselves in the wholesale market, in the capital markets, with securitization, and they were funding themselves with the FHLB. They were very heavily exposed to the FHLB, and my friends at the FHLB will take offense at this, but that funding was expensive, and it came with covenants imposed on the bank that were quite restrictive. So they were looking to diversify their funding, and they were looking for cheaper funding. That was combined, if you will, with Barclays expanding their American capital markets business, and based on the experience of the recent experience in the UK of the development of structured covered bonds and the success at doing that in the UK. So that the marriage of Washington Mutual and Barclays was quite timely. The structure that was designed for the WAMU covered bond actually, as I understand it, came from Barclays. They're the ones who proposed it. So it's a very unusual structure. You don't see this structure anyplace else in the world. And it's due to the FDIC and the FDIC's role in resolving failed financial institutions.
So how exactly did it overcome that problem? And first of all, what powers does the FDIC have in the situation of failure? How does that mess up a straight application of, for example, the British structure over here?
Yeah, we looked at the British structure, and this happened actually before I got involved with Barclays in working with Washington Mutual. The concern was that we would be unable to give a true sale opinion on the transfer of the mortgage assets to the SPV that would hold the mortgage assets in the standard UK structure, because of the removal of delinquent loans from the cover pool, the substitution of loans in the cover pool, that there was too much freedom to deal with assets in the cover pool for us to give a true sale opinion. If we were unable to give a true sale opinion and we granted a lien on the assets, then the FDIC has one of three options to deal with the obligation that's secured by the lien. The first option is to find an assuming bank to take over the obligation and to take the assets. The second alternative was for the FDIC to repudiate the claim, which means that they would pay to the holder of the obligation effectively the market value of the obligation. And the third alternative was for the FDIC to do nothing, to allow the bonds to default, to allow the trustee under the lien of the indenture to foreclose on a collateral pool and to liquidate the collateral pool and distribute the proceeds to the holder of the obligation. Those were all fairly clearly understood, but we never knew which of the alternatives the FDIC might choose to take. And as you heard this morning, luckily in the end, with the failure of Washington Mutual, they found JP Morgan to take over the obligation and to take over the cover pool.
So if I understand those correctly, in the first case of finding another bank willing to take it on, as actually happened, that's fine. It's absolutely fine. JP Morgan is there. It's a very safe credit, very straightforward. I could draw a parallel between the situation with Banco Popular in Spain and Santander acquiring them and the resolution directive in the UK there. And in many ways, that third option of let them default and let the trustee liquidate the pool is kind of what the rated risk is. So that's fine. It's the second one, that repudiation, which was the problem. Essentially, it would create an acceleration of the claims. It would make the bonds pay out at par.
Yes, and in the structure that we actually ended up putting together, in the event of the repudiation by the FDIC and the acceleration of the bonds, there was a standby investment agreement to take the money from the repudiation and invest it through the life of the covered bonds. It's part of what added to the costs of the structure.
So I take that 100 of cash, I reinvest it until whenever the bond was supposed to mature.
And curiously, that agreement was with AIG, which had its own problems in the crisis.
Right. And then, so the thinking of putting it into JP Morgan, I suppose it's a nice simple answer, but how, was it bundled up with everything else within Washington Mutual? Was it the FDIC carving out this and saying, have it? How did that process work?
My recollection is that that JP Morgan took the entire branch network and the deposits and the liability for the deposits together with the cover pool and the liability for the cover bonds.
And of course then everything was fine and because it went to a creditworthy entity.
It went to a creditworthy entity. The bonds all paid. In kind of in sharp contrast to the experience of the holders of the senior bonds, bonds issued from the holding company. I think the bondholders got something less than 5 cents on the dollar. So the covered bondholders came out of it very nicely.
With obvious parallels to the bail-inable debt that we currently have.
Somewhat, yes.
Yeah. And then when you're speaking to Sandra Thompson earlier, she mentioned some of the initiatives that had been going on since then, all of these ultimately failed initiatives to reform housing finance. I know that you have very closely followed the Covered Bond Act that attempted to get through Congress. Can you tell us a little bit about what that was trying to do and how it did it and why it failed?
Scott Garrett initially introduced a covered bond bill, I think, in 2008. It was a surprise to everybody I had worked with on covered bonds, where his desire to enact covered bond legislation came from. He hadn't been known for being involved with covered bonds at all. That initial bill was fairly minor, but that developed into the bill that was passed by the House Financial Services Committee in 2011, which was H.R. 940. That was a very well-developed piece of legislation. It passed the Financial Services Committee 44-7 on a very strong bipartisan vote. It was voted out of committee and went to the House Ways and Means Committee, the Tax Committee, where it languished and never came out of that committee. It was from my perspective, a very good bill. It established covered bonds as a, if you will, as a separate class of securities. It covered 6 asset classes, somewhat to the dismay of many European proponents of covered bonds. It covered residential mortgage loans, commercial mortgage loans, auto loans, public sector loans, so loans or debt issued by municipalities or state governments, student loans, credit cards, and I think I've now got 7 actually, and small business loans. Right. So it was a fairly wide variety of assets. I think somewhat as a compromise, that if you were going to put special legislation in place, it ought to cover something more than just a narrow sector of residential mortgage loans.
It's strange how so many of those are now becoming part of the debate. Loans to small businesses.
Indeed.
In the ESN debate here in Europe, it's
Indeed.
ironic. But it didn't get through the Ways and Means Committee. Were there any fundamental flaws? Were there any major objections, or just the Ways and Means Committee was too difficult?
No, I don't. There was no, to my knowledge, it was never actually taken up for discussion and consideration by the Ways and Means Committee. It was assigned to the Ways and Means Committee, as many bills are, to consider the tax impact of the bill. In this particular case, in the event of the insolvency of the issuing institution, there would be a separate estate created that consisted simply of the pool of mortgage loans and the obligation for that. And as a separate estate, what the tax treatment of that was going to be. And in particular, if mortgage loans were sold out of the separate estate, would they be taxable? If they were sold, for example, at a premium into the market, was that profit going to be taxable or not taxable? Under the bill, it would not be taxable. So there were tax considerations to the establishment of the separate estate. But I don't think it was ever actually taken up and actually debated in the committee.
Did that reflect that there weren't really any banks pushing for it? And I suppose my next question, if it had got passed, would it actually have been used? From an economic point of view, is it necessary?
Is it necessary? I think, as we heard from Sandra Thompson this morning, the GSEs today still finance 90% of mortgage loans in the United States. From the perspective of banks, I'm told the most profitable way to finance mortgage loans is through the GSEs. Anything else, banks make less money on. From the bank's perspective, accordingly, I think they would prefer to see the GCs continue as they are.
Mm-hmm. In conservatorship.
In conservatorship. That leaves not much by way of mortgage loans to find other funding for. You combine that with the fact that the Volcker rule was passed with the Dodd-Frank Act and the regulatory side of Volcker enacted a couple of years later. It sharply limited what banks can invest in. So mortgage loans have become a very attractive asset for banks. And combined with funding 90% of your mortgage loans through Fannie Mae and Freddie Mac, the rest of it's very attractive to keep on balance sheet. Would it have been used if it had been passed? Possibly. The other thing to remember, I think, about covered bonds is they're really most attractive to lower rated banks. They're most useful to banks that are rated triple B or single A, where the kick up you get in your rating because of the cover pool, you get a full 2 notches increase for a single A bank that takes them to triple A. For the more highly rated banks, it's not, you don't get the same benefit from it. So the strongest interest really you would expect to find from smaller, lower rated institutions. And they don't carry the same influence in Congress in getting legislation passed. Mm-hmm. If the legislation had been enacted, would it be used by that tier of banks? Is an interesting question. I don't know.
Another point that Sandra Thompson made today was that there's actually nothing stopping anyone from doing one of these, and your triple B rated banks there. Do any of them ever look at it in the absence of legislation, just copying the Washington Mutual structure, or is there a better way than the Washington Mutual structure now, just under contract without a law?
I haven't seen any interest in banks looking at being a guinea pig to issue covered bonds into this market. It would take obviously a fair amount of internal attention and development costs to bring to market a structured covered bond. Mm. And I think, again, with the availability of funding through Fannie Mae and Freddie Mac, that the incentive to do that isn't there. So, she made the point this morning that she didn't expect to see covered bonds until after the resolution of Fannie Mae and Freddie Mac, and I think she's right. Unless Fannie Mae and Freddie Mac are cut back to something like 50% of the market instead of 90%, there's not enough economic incentive there, I think, to drive people to try something.
Okay. Which kind of leads conveniently onto my last question, and after that I'm going to throw it open to questions from the floor. My last question, another thing Sandra Thompson said was that no one can really speculate about what's going to happen. It's very difficult to be certain about that, so I'm going to ask you exactly that. What is going to happen with Fannie and Freddie, just your personal opinion? Put you on the spot.
I don't see in near term, I don't see any prospect of change. The question was asked from the audience this morning, would it be different if Fannie Mae and Freddie Mac and the liabilities were carried on the balance sheet of the United States? If it had an impact on the debt ceiling in the United States? If it had an impact on a bond rating in the United States, would that force some resolution of Fannie Mae and Freddie Mac? The answer may be yes, but we kind of live in it's a pejorative term, so I don't mean to offend anybody, but it's a little bit of a fantasy world where the U.S. is responsible for the obligations of Fannie and Freddie, and yet they're not carried on the balance sheet. And I don't see that that's going to change. And the situation, the way it is at the moment, is too comfortable for too many segments of this society. It's comfortable for people who are in the home construction business. The availability of mortgage loans through FHA and Fannie and Freddie are very important to the home construction industry. The huge pool of government guaranteed bonds that Fannie and Freddie issue are really important to the traders on Wall Street. It's a huge business. And they have a very strong vested interest in seeing that business continue. The people who are involved in promoting housing for for lower income people have a very strong interest in seeing Fannie and Freddie continuing to support lower income housing. So you're left with perhaps only a few academics who really want to see it change. And that's not enough, I think, in my mind, to produce a change. So I think we're stuck with the status quo, at least for the near term. I don't think I see it changing.
Do we have any questions for Jerry? Well, check, yeah.
Great.
This is a counterpoint, right?
I think this is good.
Considering that Mayor Brown is our underwriters counsel on the USD covered issuance, can I hold you to that 24-hour turnaround promise you brought up at the beginning of the session?
Any other questions?
I think the answer has to be yes.
Thank you.
Got a room full of witnesses. Are there any other questions? Okay, in that case, we're going to hand over to Bill, who's going to be speaking about the outlook for the global market, I believe. And whilst we hand over, please join me in thanking Jerry.
Thank you, guys.